Hi, I'm Pete. I'm an American living in Southern California, married to a Russian wife, Alessia. You've seen me on some videos before. I was on one recently on Alessia's channel where I was talking about my visit to Moscow. Now I'm going to talk a little bit about the attitude of Russians and Americans toward money and investing. Another topic that I thought you'd be interested in, and I have some perspectives on. I've had a lot of experience over the last dozen or so years living and working in Moscow. So I have a lot of observations about Russians and their attitude toward money and investing versus Americans and their attitude toward money and investing. So one of the things that I found really interesting about and different about Russian attitudes toward money is that because Russians are so used to dealing with the crisis time, the Russian attitude toward money in a lot of cases is it's here today, but it could easily be gone tomorrow. They've been through crises and they've experienced loss of money where, in 1998 there was a debt collapse of the economy. People had been wiped out. Other people had to rebuild following the fall of the Soviet Union. Consequently, there's a lot of push toward having physical goods as opposed to putting your money in the bank or investing it. Buy physical goods, buy houses, real estate. If you've got the money, buy houses, real estate, cars, furs, other physical goods.
I still think that fur coat is a very good investment. Not because my mom has been a director of the fur factory for really many years, but because when you live in Russia and you regularly have a cold winter and you invest in something which will actually stay good and decent for many, many years, then this is a good investment. The fact that Russians like to own, for instance, their real estate actually goes from the past. The Westerns always underestimate how actually well-doing or rich we are sometimes because we own a lot of property. Like most of the Russians own apartment or a house or a dacha. The Soviet legacy did help us, our grandparents, our parents, to get apartment, to get a big apartment from a smaller apartment, so that we as children, we get already property. I mean, we didn't have to buy it, we have it already. So when the crisis arrives, it's actually good that we don't have to pay, most of us don't have to pay any mortgage, any credit, we don't have to pay for a rent because we do live in our apartments or houses. We have been living in our own places for a long time as generations, and we like this feeling of living in our own place. And for sure, because our economy is unstable and there have been several crises, owning a place to live actually still is a very stable thing.
If you like this video and you really want to see more, like it and comment. American attitude toward that is much more like, well, yeah, real estate, it's a good investment, and we want to own the house that we're in if we can, but they're much more into the, shall we say, the virtual economy, so things, services, things that are experiences as opposed to hard physical goods. Also, the American economy is much more geared toward credit, getting it and using credit to extend your financial capacity. In fact, I read that at the end of last year, the American consumer debt was $15.6 trillion. That's almost as much as our GDP for a single year. So it's massive consumer credit debt because in America, it's much easier to get credit and they're much more comfortable using credit.
I'm still being surprised when I come, for instance, to Macy's and I'm buying a shirt for $50. So what I hear at the register is will you use a Macy's card today? I'm like, no thanks, just my own card. Oh, why? We would like to offer you a Macy's card. It will just take 5 minutes. At almost every single big store in America, this is what they will offer you. So get our credit card. Just get our credit card, it's so easy and then you can use it. I just hope that many Americans are financially smart so that they can later manage all these credit cards.
In Russia, again, the attitude is, it's here today, it could be gone tomorrow. Spend money on physical goods. As far as credit goes, they're kind of uncomfortable with credit. for a few reasons. One is that, again, you can't see it, feel it, hold it. It could slip away, right? And they're worried about that. Also, because of the volatility of the currency, the volatility of the economy, interest rates are high. And what that means is when you get a loan, you're paying a pretty high interest rate, if you can even get a loan, right? So that means that there's going to be less credit used by consumers in Russia. So consequently, you see a lot less use of credit for things like buying homes, or like a mortgage. People are using mortgages, but not as extensively as in the U.S. Buying cars, buying any physical good, anything that's a large investment.
One interesting thing I noticed is that Americans are so used to getting actually big things in credit, they don't even notice, they don't even mention that this is credit. For instance, usually American will say, oh, we finally bought a house. We bought a house and that's a cool house. And as a Russian will think, wow, well, good for them. They earned this money. They're rich. They just, finally got a house, the house with the pool. Then in the conversation, you get the idea oh, they actually got a mortgage. I mean, they paid some sum and then they will pay another sum for 30 years. I mean, they didn't buy the house. The house doesn't belong to them. But the way they will say about it, I bought a house. Russian will say, actually, I took a mortgage. And they will say something like, well, I was thinking about it. It took me a long time, made a big calculation. Yeah, I really need to change this apartment for the bigger apartment. So, I finally decided to take a mortgage.
The way the credit works in America is you need to establish a credit identity and a credit score. So if you're a citizen or green card holder, you will open up some accounts, your credit card account, a bank account, etc. And you may buy a home. This is a way to make investments and establish a credit score. All that stuff is tracked by some credit rating agencies, right? And so you need to have those types of investments, or at least some of them, to establish the credit score. And the credit score is, think of it like a standardized test where the scale is 0 to 900, right? You want to be over 700. That's a good to over 800 is a really excellent credit score. So 7 to 900 is where you want to be. That's based on having investments, credit cards, other credit, and paying your bills on time, not having a lot of debt that you roll over, like where you pay a little bit of the balance, but you let it roll over. That's bad because not only does it increase the interest you're paying on that loan, that credit card, but it also lowers your credit score over time. You want to pay your bills on time, in full, as much as possible, and just not have a lot of mess, like debts or situations where you failed to pay for things or you have a lot of outstanding debt. So that's what the credit score is, and it's really important because anytime you're going to make a large purchase, whether you're going to buy a home or even rent a home, whether you're going to buy or lease a car, whether you're going to make other large purchases, they check your credit score. And they, again, want it to be over 700. So in order for you to get the best terms on the loan you're getting. And usually you are getting a loan. Like for real estate, the typical situation is that when you're buying a home, like a standard way to do it would be to put 20% of the purchase price down. So you would pay 20% and you take 80% as a mortgage. And there are a lot of people who actually, especially in expensive real estate locations, pay a lower amount down, maybe 5 or 10%, and they take a bigger mortgage. But in order to get that mortgage at a reasonable rate of interest, you need to have a good credit score.
In a way, this is totally the opposite of what we think in Russia. In the Russian mentality, having a lot of credit is bad. That means you owe, that means you collect debt. So that's really not good. I mean, you can take some credit to buy some special things, and for sure, this is more and more offered, but it's not like you try to get even more credit every time because it will be eventually good for you. This idea of credit score doesn't exist and is very, very strange. After having lived in the US and organizing our life here for almost 4 years, I could say my attitude towards credit is the following. Using credit for some things, and especially in some situations, is great. For instance, we came here, we didn't know, and we still don't know for how long we will stay in the US. So we got, the car with the leasing schemes, and we leased the apartment, so we kind of don't want to own a place here yet. And we use credit here and there for buying small stuff, which is great, because it also gives us space for using our money for investments. But using too much credit here, like buying everything in credit and getting all kinds of credit cards, as many as possible, I think is too much. I see the benefits of Russian mentality, where clearly we like to own stuff rather than to get the stuff in credit, because the stuff in Russia in this way is more real. When you see the guy on the Mercedes in Russia, you could tell the guy either earned his money to buy Mercedes, or he, if it's a younger guy, okay, probably he has rich parents who bought him Mercedes, or okay, maybe he did some schemes, maybe he stole some money, maybe he's like a kind of like a bandit or something. But anyway, he got the money to get this car, right? So clearly, if the guy has the money, he drives Mercedes. If the guy doesn't have money, he will drive Zhiguli. This is clear. In the US, if the guy drives Mercedes, pretty much it doesn't necessarily mean that the guy has the money and the guy he is rich, because he could get this Mercedes with credit, he could get this Mercedes with leasing, he probably just drives Mercedes for a day or something else.
I love to invest. I think it's great, and it's really important for the long-term health and prosperity of the family, and particularly if you make a good income. I think you owe it to yourself to learn how to invest and invest wisely. Well, personally, I think you should do it yourself, unless you're talking about 20 million plus. But if the vast majority of us aren't, and I think you should, if it's less than that, you should learn how to invest yourself. Why do I think that? Well, first of all, investing isn't gambling, right? And again, the attitude here isn't that the money's here today but could be gone tomorrow. The markets in the U.S. have been steady and pretty stable over time. And investing in things like the stock markets, so investing in stocks, mutual funds, and ETFs, exchange traded funds. These are different investment interests that allow you to invest in the market. It's over time, it's been very beneficial. Talking about at least 5 to 10% rate of return per year on your money, and often more than 10%. So that's a pretty good rate of return. So that's why I think it's good and important, the right thing to do. If you do it the right way, you're not taking a big risk. There's always some risk involved, and when we had the financial crisis in 2008, there was shaky and scary time for banks and for the markets, but we got through it, and the government, frankly, wouldn't let the banks and the market system collapse, and they kept pumping money and liquidity into the markets to keep them afloat. And in my lifetime, that's really been the only time where there was this worry about the stability of the markets. Otherwise, it hasn't always been totally smooth sailing. You had the dot-com crash in 2001, for instance, but in general, it's been pretty stable and pretty reliable and good returns. If you're interested in learning about investing, what should you do? Well, you should read and talk to people who are good investors, and think about it from a long-term perspective. I always think that if you're out there to make a quick buck, if you're out there to make 100% return on your money in a week, a month, even a year, that's not going to happen. And you're more likely to lose money if you have that kind of attitude. But if you say, hey, yeah, I like the idea of putting a reasonable amount of my wealth and savings into investments, and I'm okay with 5 to 10% gain per year, and it's the right thing to do, and I'm patient with it, then that's good. That's the right attitude and approach for investing. How do you learn about it? How do you learn to do it? Read a lot, talk to people. What I read are things like CNBC. I read CNBC online because that's got the latest and greatest news on the stock markets and companies that are big and important companies on the U.S. Markets. Internationally, you can read the Financial Times online, which is very good. It's a British newspaper, but now it's online, so you can read that. The Wall Street Journal is another excellent newspaper to read. I also read magazines online again, like Fortune and Forbes, that give you a long-term investment approach, good thinking on investment style, companies to invest in, markets or areas to invest in. I also read Kiplinger's, which is more oriented toward preparing for retirement or kind of long-term investing, and but very good and very informative. So those are some of the things I read. I know in Russia, Vedomosti is good, Kommersant is good, but just read as much news as you can on the financial markets. Again, talk to people who are good, who are knowledgeable about long-term investing.
Right now, I'm like at the very zero level of investment knowledge, and the only advantage I have is that I have a husband who really knows what he's doing. So I have a lot of opportunity to learn from him sooner or later, which I'm planning to do. What I see is that he's really reading a lot. He's reading every day a lot of news, and he's especially reading about the companies in which we invest. For instance, if we invest in Amazon, which for sure has been a great company for investment for a long period of time already, then he tries to follow all the news regarding what's happening inside, what's happening with employees, what does CEO say, what problems do they have, and this gives him this kind of background knowledge of whether we should keep investing or we should stop investing, so kind of the decision making process.
Investing for the long term is always a good idea, and whether you're in a crisis or not, there's a lot of validity to it. So my advice would be look at taking at least some reasonable percent of your savings, like 10, 15% of your savings, and start to invest that. Invest it in some relatively stable things, like you have blue chip companies in Russia, oil and gas, energy companies. For instance, they're probably the most stable from a long-term perspective, and actually, given the situation with the oil price and gas shortages in Europe, that the Russian energy companies are going to do very well. So that's a place to look. In the U.S., I'm often looking at technology and financial services, tech companies and banks. Not startup tech companies, but ones that are bigger and make money and have been making money for years and have a proven business model are some of my favorites. This was just some introductory comments on investing and attitudes toward money. If you're interested in more specifically on investing and you want me to talk about some of the sectors and some of the companies that I invest in and my strategies and how I do things, please write in the comments and let us know, and we'll have more on that. Thank you for watching this video. Please subscribe to this channel and look out for more exciting videos.